All right, we can see a few people join in. Thank you so much for joining. And This is Anubhav from Find My Real Estate. Just waiting for a few more minutes. Probably allow maybe 2 to 3 minutes for others to join, and then we'll get started for tonight's exciting topic called Commercial 101. So just a couple of more minutes, and then we'll get started. So it's pretty cold here in Melbourne. Those who are in Melbourne, and I believe this is obviously, thank you so much for joining on this particular night. Okay. Okay, just a few more minutes. Thank you. We'll get started. Okay, we can see a few more people join in, which is great. I hope you can all see my screen. If one of you could just probably type on the text. If you've got any questions, you can put your questions through on the chat box and we'll try to take your questions at the end. We are also available for you to call us on 1300 567 424 or ping us, and we can also have a private chat as well. But if you've got any questions tonight, please feel free to put that in the chat box and then I will try answer them at the end of the session. But for now, just so that I know you can all, my audio is clear to you and you're able to see the screen, if you can just put that on the chat box, that'll be great. Just reply yes. Awesome. Thank you, Sam. I can see that. Thank you very much. Okay, perfect. Okay, just one more minute and we'll get started. Thank you. All right, let's roll it. Thank you so much for waiting, and once again, thank you for joining tonight. This is our fourth event that we're doing and running a webinar series on fortnightly basis. So the topic tonight is Commercial 101. So it is going to cover the fundamentals of commercial, but also why and how to buy commercial with its pros and cons. And there are a few examples to support the theory aspect of it and show you some examples of properties we've purchased for clients as well. So give you an idea about how does that practically really work out, what sort of properties are available, what sort of properties you should be buying, and we will cover that today as a fundamentals around commercial. So before we get started, a legal disclaimer. So Find My Real Estate and its associated entities take no responsibility and disclaims all liability for any losses, damages, or costs as a result of use of information tonight. This is just for education purposes. So please seek your own legal independent advice and financial advice as you deem right. And past performance may not be indicative of future results. So if you've got any questions in relation to tonight's content, we're more than happy to answer that on one-to-one private basis as well. You can reach out to me separately, or you can even put questions down there tonight on the chat box, and we'll try and take those questions at the end, those who just joined. So thank you so much, and let's get this going. So I just want to introduce myself for those who don't know me. So Find My Real Estate is a buyer's agency, although it's been 6.5 years now that we established. And what we do really matters because we're not about just buying a property, but we are about creating wealth for people through building the right portfolio for them. And we're trying to make it really easy. My background is I've been in Melbourne for 21 years now. Came here in 2004 and did my master's in engineering and at RMIT, and then 13 years of good career track with a large corporate, global corporate, and reached out senior positions. And then pretty much I was done with it, and I wanted to do something for myself, for my own freedom, and really something that I enjoy. So thinking through that 6.5 years ago, in 2019, I started Find My Real Estate, and with a pure passion that I want to help people, build the right portfolio for them. And that's what led to this journey. And 6.5 years now, we are sort of more than about 600 plus clients that we've served all over Australia, and we buy both residential and commercial with key focus on building early modern retirement. I mean, the idea is why you want to retire in 60 and 70 when you can do that early. And today's topic with Commercial 101, you will see positively geared properties, you will see positively geared outcomes that we have achieved for clients, even in this high interest rate market right now. So how do you actually buy these type of properties is really important, because ultimately for retirement means that everyone wants passive income. So what people are really chasing is growth at this stage. And yes, growth is really important, and we want to balance growth and cash flow. And that's what balancing portfolio means over a period of time. Now, these are just some of the recent results we've seen through residential sector, where we've seen double-digit growth, even when Victoria, as an example, hasn't done anything for the last 3 years. Those who are in Victoria, you probably know the pain, but most of our clients have seen these results across different states, and we've seen 58%, 23%, 33% type of growth in these areas where we've had to very at a very low point keep the negative getting around anything between $8,000 to say maybe $12,000 or maybe $14,000 if it is in superannuation. But that's where the negative getting ends. But the idea is that if you've got a few negatively geared properties, tonight's session is going to allow you to be able to see how you could supplement some of that negative gearing with a positively geared properties through commercial acquiring as well. So before we deep dive into actually the commercial 101, I really want to also highlight the market view. So this is as of the 31st of May. If you did not join my last session 2 weeks ago, then I had presented that at the same time. But just to let you know where we stand nationally. So obviously Sydney always leads the pack with the median price point of 1.2 million. Usually it is Melbourne that follows, which is somewhere around maybe 800, 900K ish type of median. But as I said earlier, Victoria hasn't done much in the last 3 years, and that's fallen behind quite a bit. So we've had Brisbane on the second number. We've then got obviously Canberra, which is also taken off, and then you've got Adelaide and then Perth. Now, no surprise. I mean, of course, Melbourne sitting at number 6, which is not where its usual position should be. So the idea is that what we are seeing now is market shifting towards Victoria. And given that I've been in Melbourne for 21 years, we know what we're doing here, and we are quite aggressively buying back again in Victoria. Although markets are quite distributed at this stage, the temperature in different markets is quite varied at this stage. Some of them have gone really red hot already in regional markets, whilst others are very, very cold. So it's a you can probably put it on the spectrum, and you'll find that depending on where you live, what you know, you might see really no activity to what we are seeing is a lot of activity in Victoria right now, where we are actually buying properties for our clients. But that's the snapshot to just to give you where the median price points sit. So if you are looking to invest, again, this is no advice, but just looking at the median price points there's opportunities right now across the board, but Melbourne is absolutely standing out to be the case right now. With the interest rates right now, we are sitting at about cash rate of 3.85%. So most of us would have seen reduction already happen through the interest rates. Banks have slashed those rates as well. We've had 0.5% reduction as two interest rates cut have happened in the last 3 to 4 months. We are expecting probably another one happen in July, which is only probably another 3 weeks, 4 weeks to go. And that would be really awesome if that happens. But there is a good forecast of at least two interest rates cut over between July and December this year alone. What that does is allows people to borrow more. It gives them into a comfortable position to be able to spend the money, and then again the money goes back into property. So if you've been sitting on the sidelines for the right time, I cannot stress it enough. In the last 6.5 years, I don't remember a time I've told anyone to wait before market can pick up. Markets have always been great. You just have to be in the right market at the right time. And if you really don't know what you're doing and you don't know how to actually really sift through 15,000 suburbs across Australia, then you've always got help to to seek for. And of course, the professionals like us, we are trying to help you, get you into markets which you would normally be fearful about, and design the portfolio the right way. Inflation is sitting at 2.4%. So again, this is all sort of now stacking up for another interest rate cut, as I said, which is fantastic. And we can't wait to see that another rate cut happening. So in my discussions with a lot of people that I've had over the last 6.5 years, and thousands of people we've spoken to, most people are very comfortable with this sort of a passive income number, which is $150,000, in about 10 to 15 years. So if you're in your 40s, we're talking about somewhere around mid 55. If you're in your mid 30s, then you're sort of looking at around just about 50. So reaching half a century, if you've got this passive income going for yourself, and where most of your responsibilities are done with your family, with your children, then that's the number that people are most comfortable with in today's dollars. Of course, inflation added, once you have a portfolio, that will take care of itself, but in today's dollars, that's the number that people are most comfortable with. So passive income is the way, because you cannot lose money if you're already making money through actual passive income, right? Absolutely, cash is king, and we hear that all the time. So if you're getting cash at home, and it is positively geared, if you've paid off some properties, that money is coming home as long as your property continues to be tenanted. And of course, that's what it means by having the right portfolio and the right tenancy, and a mix of portfolio type of properties that can actually last long, and really continue to keep reviewing that over a period of time. So if you don't know how to do that, you've got help to ask for. All right, so let's get started with commercial. So firstly, let me introduce the type of commercial properties that usually exist in the market. So you've got retail, which is like shops, cafes, strip of malls. You've got shopping centers, right? We all know about shopping centers, and we know about cafes and shops. So that's really what you see every day whenever you walk the streets. Then you've got office space. Of course, CBDs are full of these. So corporate offices, co-working spaces are becoming the norm after COVID. And of course, you've got medical suites as well. Now, these medical suites can be set up in an office type environment. And a lot of the ones in the suburbs are also set up in a normal house with a 4 bedroom, 5 bedroom, 6 bedroom type. And you've got, individual rooms being also used as medical suites as well. So as long as it is in the right zoning, that's actually allowed to do so. Then we've got industrial. So this is like the warehouses, the factories, logistics, and distribution centers. Nowadays, warehouses are also very popular for small office spaces, and people actually use it for office spaces, which is really great way for people to see themselves into that sort of space, where you've got the mezzanine, you've obviously got a space at the bottom, and then you can split the space into multiple tenancies as well. So a lot of people are choosing warehouses where that's available for them, especially when, in suburbs, if you don't have any office space as such, then warehouses are starting to become a little bit of norm in some of the areas that we know of. And that's where a lot of people, white collar people who want to own an office, is also using warehouse for themselves. Mixed use is development, so it's combining residential and commercial use. So I'll talk about that in a second and show you some examples. Then we've got specialist type of commercial, which is childcare centers, medical clinics, service stations. These sometimes sell with the business or without the business as well, but they are, of course, on the higher end of the price points that we're talking about, and you've got to spend a few $1 million to do that, or you can develop something like that. But absolutely something that can give you really good cash cow going for yourself. And obviously, it also has its own great valuation as well. Now you can see some of these examples shown here with the childcare, the medical center, the resi-mercial, which is a mix of residential and commercial all within one building, the strip shops, office, warehouse, and a shop in a business center as well. So there are the different types. Now, which is right? Which one should I be buying? What is right for me? Should I be buying a warehouse? Should I buy an office space? Should I buy a car space? Should I actually buy storage units? Because that's another big one as well. Lots of people are investing into storages nowadays. It is the need of the hour. The families are only growing bigger and bigger, and people don't actually get rid of their stuff. They keep storing stuff. So you really need the place to keep it. And of course, garage becomes a standard way to store your stuff. But once you've done with it, where else do you put your stuff? So therefore, hiring a storage space is becoming a lot more popular, especially with growing families and young families that really have a lot of stuff to actually keep. Then, of course, you've got generations of stuff that is being held. So all that stuff has to be stored somewhere. and therefore storages are also becoming extremely popular as an investment space as well. Although I haven't mentioned it here, but that is something to sort of look at as an industrial sort of activity. But complementing to the warehouses, you've got this storage space as well. So now, as I said, which ones to really buy and what to do will come down to individual risk appetite and what the need is, right? So, in most cases, like if you buy an office space in a big, large vertical building in the CBD, for example, you might feel really safe that the office space is really good. I can, be there. We know we might get a rent, but you might not get enough growth, right? Right now, there is obviously a huge issue with the vacancies as well in the CBDs. Right after COVID, we haven't had CBDs going full, but there are many areas and suburbs that actually have mini office spaces that are quite full. So it really depends on the location, right? You don't have to go high rise density apartment style type of offices or apartments, even if you're doing residential, but you can buy something which is in the right area, in the right space where you don't have too much supply, but there's high demand. So it all comes down to your due diligence as a result that can help increase the value of the property as well. I'm not too much of a favor of office space unless it is for your personal use, but there are so many different options that you can get into. The easiest ones are warehouses, but again, depending on metro versus regional and where you're buying these warehouses, the yields can vary quite a lot. And you don't want to settle on a very low yield either, by going too safe into an area. But again, as I said, it's a risk appetite conversation. Like, do I really want to buy something in metro and have the peace of mind? Or I'm quite comfortable going into remote areas or regional areas which are large cities in their own right and still be able to get better yields than for what my money can actually chase. And that's a conversation to have, but a lot of it depends on knowing local areas, the demographics, what are the needs, what are the businesses running in that area, and then choosing the right type of asset class to be able to, within the commercial space, to buy the right type of commercial for yourself. Like, you could probably go into a shopping center and buy something within the shopping center, but again, that's one small unit out of the whole shopping center. Now there could be a lot of vacancies in the shopping center, and you might not have a tenant for a long time. So that could also escalate your risk as well, and also the value might not go up as much. But if you have a mini shopping center, you buy the entire shopping center in a regional area where you've got this strip of shops. Let's say there are 8 or 10 of shops that you are actually buying, and the entire shopping center is yours. You've got these multiple tenancies that are actually operating as part of the small area. That's a great buy because you're not just buying a piecemeal, but you're actually buying the entire shopping center. And they're not very expensive in regional areas. They're not into 10 or 15, 20, $30 million. We're talking about a small size shopping center where you've got few shops, but you own the whole thing. So again, comes down to the liking, the budget you have, the risk appetite you carry. But these are the things that usually people are end up buying the right way. And to mitigate the risk, people are obviously looking at multi-tenancies as well. And I'll talk a little bit more about that in a second. But these are the things to look at. Then there are developers who are obviously very keen in developing the right commercial zone land for their purposes. So for childcare, for example, or maybe for that matter, if they want to build warehouses or subdivide the land and then sell them off. So it's a huge profits actually locked in as part of this, because building something which is commercial in nature is very fast actually, because these are all prefabricated. They come in, and the whole building gets done very, very quickly. So it of course follows a process, but then like if you've got experience in construction in residential side, the commercial side, like a warehouse style type of activity, or even for that matter, if you have to build out a medical centers or childcares, there are specialists who do this work, and that's where they do this every single day. So if you have the right money, you know what you're doing, then that could become a great way for you to be able to get an uplift. A lot of people think that I can buy land and then build. By the time the build is completed, I can actually get really good growth. But that can also, it means that that same thing applies within the commercial space, but the numbers are far better as a result. So that's the different way of doing it. Now, just going back to real fundamentals of commercial, and what is the key difference between the commercial and residential when we are looking at it? Now, when we talk about market value, the commercial is based on net yields and the cap rate, right? It is driven by numbers. It is not driven by emotions. Whereas the residential value, market value, is dependent on the comparables of the price points of the properties, the look and feel. The likewise, when you talk about 3 bedroom, 4 bedroom, the configuration of the house, the actual land size itself, the location, and the houses that have sold nearby. So it's a lot dependent on market comparison. And there is a gray area when it comes to residential. You cannot say per square meter, this is what I'm going to be able to buy this established property. You could probably do that for a new land and house, where you could probably figure out what's the per square meter and then sort of try to buy property that way, to bring in some sort of rationale to that type of buying. But in commercial, it's all numbers driven, right? And that's a key difference between that. A lot of buying in residential is done through emotions, but in commercial, it's all numbers driven. The value that you decide at what you want to buy the property at is driven by numbers as well. And today I'm going to show you some practical examples of how to do it. We'll even go through that whole, I'll step you through this whole thing as well, so you get an idea of what I'm talking about. Having said that, a lot of people who just want to acquire commercial and they are behind the herd mentality and they get caught into FOMO, they just throw the money and buy anything under the sun. Or sometimes they also buy with emotion as well. I would probably, talk to all of those people to say, get educated, because you really want to make sure that you're picking the property in commercial just based on numbers. Let me give you an example. Let's say there is a residential property for 500,000, right? And now, let's say in 12 months' time, that 500,000 property is not going to become overnight $800,000 unless you did something with the property. But if you just bought the property and you held there and you did nothing with it, it's not going to turn into a 300K growth all of a sudden. That doesn't happen, right? It'll move with the median and it'll take time before that happens, right? In commercial, it's completely different. It is not time dependent, right? It is numbers dependent, right? Time has no factor to it. I can change the value of commercial overnight, right? If I know what I'm doing. And I'm going to show you some examples by that tonight, and you will see what I mean. So there's a lot of shift in the mindset when you're actually talking commercial. The other big element is that when you are looking at residential and when you're looking at commercial, the tenant is very different. You've got mom and dad type of tenants, family living in a residential house, and you've got a business running in a commercial. So you've got to really change the lens when it's business operating there, because you have to, even if you have a property managers for both the cases, the way you deal with people as a tenant in your business is quite different to the way you would do that in your residential. And once you understand the business mindset of the commercial person who's in your premise, you can keep that same tenant for a very, very long time, right? You work with them when they are doing hard. For example, COVID, right? We've had this sort of thing in COVID in real time. A lot of people couldn't pay the rents, so lots of landlords, actually, rather than losing tenants, they actually said, okay, we'll forego your rent for some time, maybe 3 months, maybe 6 months, right? Or maybe reduce your rent for some time, maybe, make some payment plans out of it. Or some people might be like, okay, well, it's a great location. I mean, it's a great retail shop that I own, that I've got my business running, but I don't have air conditioning in this, and we need this in when it's really hot. So by installing air conditioning, right, can change the whole experience of the business in that property and for their clients. So you have to think about that business, and you have to think about their clients as well, who are going to be coming into that premise as well, right, which is your property. So when you understand that type of behavior, the whole way of how you deal with the tenant in the commercial space changes, which we don't do in residential. Residential, you got a property manager. Okay, the tenant comes, leaves, goes. Fine, you got another one. It's just recycled, right? But in commercial, you have longer leases. You actually allowing your tenant to stay there for a lot longer, and you really want them to continue to keep staying there as long as the business is thriving, right? But keeping that sort of partnership going with your business tenant can actually go a long way in your actual lease itself. So keep this in mind, that you have to really shift your mindset. You need to have a different risk appetite when you're looking at commercial for yourself. The other one big difference is that in residential, you could probably buy and sell quite quickly if you're in the right market, right? Because there will be more buyers for residential type properties than there are for commercial. So therefore, be aware that commercial will take time to sell. Even if you put in the market, if it's a normal market, it's not crazy market out there, then you could be in it for 3 to 6 months before you would sell a commercial property, right? It's a slow burn. Buying is slow, selling is slow. Same thing with tenants as well. If you've got commercial tenants, they come with a lease and the lease is about to get over, and they're going to leave, or even if it's between the lease, if they have not been able to sustain in that business and they're shutting down and they have to leave, then pretty much, before you would re-tenant that property, it might take maybe 10 days, sorry, 20 days, maybe it may take about 40 days, it could probably take even 2 months. It just depends. So what really matters in commercial is location, right? You really want to be in really good location, and you can also mitigate the tenancy risk by actually going into more multi-tenancy type properties as well. Now, the benefit of commercial versus residential, the yields are a lot higher in commercial. We are talking about net yields, not gross. And we'll cover the definition net and gross in a second. But we're talking 3 to 14% net yields in commercial, which is where it becomes positively geared from the very get-go as soon as you settle, if it's an established commercial property. Whereas in residential, we all know of a gross yield, which is, before all the expenses. We are talking about just the rent that's coming in before all expenses and any outgoings. That's what gross means. So that's 2 to 6%, depending on where you actually buy, metro versus regional, and how far you go, right? In some cases, you might even get 7% gross yield as well if you're in mining towns, but and sometimes even in apartments and so forth, you might get on a higher yield. But don't go by the gross yield number, because sometimes it could mean that you are making decisions based on that. Oh, I've got a great gross yield of 6 to 7% or even 8%. Let's say it's a residential dual occupancy property. You've got two rents coming from the property. There are two tenants in the same property on a single title. And because you've got two rents coming, the gross yield can show that you're probably around even 8% in residential. But when you actually run through the numbers and you run through all the expenses of that property, most likely there's only one electricity meter. There could be only one water meter. There could be higher insurance, two landlord insurances, for example, instead of one landlord insurance. All these additional costs that goes on with the dual, the net cash flow that you actually get or is probably quite similar sometimes to a single occupancy as well. Again, it's case by case dependent, but what I'm saying is that don't just rely on a gross yield number and make decision based on that just because a dual occupancy is 8%, it's going to be better than actually a single occupancy, which is about 5%. That's all I'm trying to say. Whereas in commercial, everything is net, so you don't have outgoings in your pocket. Outgoings are paid by the tenant, and therefore what you're getting is your net rent, and that's really useful to really use that number for yourself and know what that actually means. Of course, you have to take the interest component out, and that's really your net. But 3 to 14% net after outgoing is phenomenal. I will go through some of the examples to show you that in a better way. So in most cases, depending on what you end up buying, where you buy, and what price point you're buying at, in most cases, commercial becomes positively geared, right? And the type of properties we buy in commercial, they are netting 6% plus, essentially, right? In majority of all the properties we've purchased. And in residential, they're likely negatively geared. In fact, if you're in metro, they are going to be hugely negatively geared. If you're in right regional markets, then that can actually, mean that on a, let's say on a 600K property in residential, you could be negatively geared by around anything from 10 to $12,000 in today's market right now, with the current interest rate of around hovering around 6%. As long as the LVR is 80%. Coming back to that LVR, so if the borrowing in residential, you can go up to 90%. The numbers I was giving you earlier was based on 80%. So 80 to 90% is quite normal. Whereas in commercial, the borrowing is anything from 50% to 80%. So, for example, storage units, if you buy storage units, you're probably not going to get more than 50%. If you end up buying an office space, which is less than probably 40 square meters, you probably won't get more than 60% lending on that. But if it's more than that, you could probably even get up to 80% depending on the bank. So again, you have to talk to your broker about that. Don't take these numbers, what I'm saying, but these are just guidelines that I'm providing based on my experiences on the ground. But you can go up to 80%. We have seen lending in commercial, the type of properties we buy, averaging around 75% to 80% as well. Now, there is also in commercial you know, there is something called lease doc loan. What that means is, again, talk to your finance broker or banker. But lease doc loan basically means that it only relies on the income coming from the commercial. So your borrowing is not required at all. Let's say you have three residential properties and you have exhausted your borrowing capacity. And you're like, okay, I can't move any forward. You can. You can still go into commercial. You don't need to worry about your borrowing capacity. Just based on the income coming from that commercial property, you could possibly buy a property for yourself. The catch is that you're not going to get 80% LVR, right? Your LVRs, which is your loan to value ratio, is going to be around probably 50% to 60%, even though if you could get 80% otherwise if you were to show your own borrowing. But in lease doc loan, you're capped at 50 to 60% depending on which lenders you go with. So you need a lot more money upfront, or you probably have taken out some equity already out. You need that cash to be able to buy that commercial if you don't have borrowing. So that's the key difference between the borrowing and the percentages. And the tenants I've already covered. The lease. Now, the lease in residential is usually 6 to 12 months that we know of. You can go up to 5 years, which is a long term lease, but usually it is 6 to 12 months. And the lease is very, very standard. So the conditions are quite standard. There's nothing you can put in from your side. It's driven by the legislation of the state you're in, and that's pretty much the way it gets dictated. Whereas in commercial, it's completely bespoke. So it is all between you and the business, what you decide, what you negotiate on, right? How many outgoings, who's paying what outgoings, right? What terms do I want? What are the things that I'm agreeing on? What are my terms for you to rent my property? And similarly, the tenant might have some terms as well. So you can write anything in that piece of document, which becomes bespoke. And of course, you've got lawyers on both the sides to help you sort of draft that the right way. But you could add anything you want. And lease is the hero of your commercial property. The whole value is based on that lease, essentially. So you really want to make sure when you buy the property, the lease is really, there's a due diligence done by the lawyers on it, and you really understand everything that's on the lease, what terms there are, what it is, whether the insurances are covered by them, by you, what insurances they won't cover, the insurances that you have to buy on top of their insurances. There's so much gray area that can come in. So you really want to make sure that you don't sign anything unless you've actually had a lawyer by your side going through the lease, because the whole valuation is based on that, and also the fact that the dealings of the entire lease, because it is legally bound, you need to make sure that it is read through properly apart from the contracts as well. So but that's the beauty of the lease within the commercial, because I can dictate what I want before a tenant agrees to that. And I'll show you an example. We are currently in process of trying to buy a property in which we are dictating what will actually go on the lease by the tenant who's already occupied the property, but they don't have an active lease anymore. They're on month. So I'll show you that example as well in a second. All right, so that's covering all that. Now, with the growth factors, again, as I said earlier, there's time component in residential property. If you're just buying the property and holding for a while, if you don't do anything with the property, like if you don't do subdivision, if you don't do renovations, you cannot just magically increase the number overnight, right? Whereas in commercial, a lot of it is dependent on numbers. So I'll talk to that a little bit right now to you, and I will go through the examples, but you know what I mean, right? So I can change the value of commercial quite overnight as well. That's what I mean. So it's not time dependent factor. And that's a crucial difference, because people always ask me, hey, this guy bought the property in 2019 for 600K commercial. Now he's selling it for 900K. What do you think will happen to this property? Will it become 1.2 million in next 2 years? I'm like, that's a wrong way to even look at it. Like, and you need to see what's the potential in the property to increase the value of the property. And I'm going to show you a real example of that tonight. All right. So how do I source commercial? Now, commercial is obviously, if you have the right access to the agents, build your agent network. But at the same time, there are lots of commercial properties that come online. So realcommercial.com.au, commercial real estate, commercial ready, all of these places you can actually go and find commercial assets for yourself. You can choose, you can look at things the way you go on realestate.com.au. You can do that in these sites as well. You can inquire about the property. You can ask the agent about the asking price, information memorandum, which is basically a summary of the entire property details, including all the information about the lease and about the area. They usually tend to give you a bit more lens around the growth factors of the area. So you probably get a whole comprehensive information about the property for you to make the right decision. Of course, the due diligence is not done at that point in time, but at least it is a initial information that is being shared with you based on what the property is all about, and you're able to do your numbers and try to figure out that if this is the right type of investment for you. So that's what you can do, and that's the information I was talking about with information memorandum. The other fundamentals you really need to know, as I said, gross income. Usually, when you see the listings on these sites, you will find sometimes it mentions net income, sometimes it mentions gross income, sometimes it only mentions the word income right from the property. So you really have to clarify with the agent if it is not very clear in the information memorandum whether it's gross, net, or what is that number that you are actually providing me. And some the gross income means that it includes outgoings as well and likely GST number as well. And I'll show you an example of that. So right after this, net income means there is no outgoing included and it is excluding GST as well. So that's your net income. That's the number you want. You want that net income. You don't want any outgoings as part of that when you're calculating your value for the property. Outgoings usually mean rates, utilities, maintenance. These are tenant maintenance, not building maintenance. Building maintenance is probably yours. So let's say you have a big space, which is a big retail space, and it's all ducted air conditioning. If something goes wrong with the air conditioning, if it's blown out, not because of tenant's fault, but just because it aged, then probably that is yours, unless it's written in the actual lease. Remember, it's a bespoke lease, so I can put anything there, but in most cases that type of maintenance is yours. But if anything breaks because of the tenant and whatever they do, all that maintenance is theirs. They're supposed to keep the property clean. Everything is up to them, and they need to make sure that they hand you property back in the same condition they actually found the property when they moved in. Insurances, of course, that is another big one. There are multiple insurances that businesses might be covered with. They probably insure the building as well. So building insurance sometimes is also all paid by the tenant. Strata, so if it is part of the bigger complex and you're buying a small piece of the bigger complex, like a retail shop in a bigger complex, then there will be a strata fee, which is a body corporate style type of fee, and that is also paid as outgoings through tenant. Sometimes it is not. So you really have to clear that activity. That's the part of due diligence to really make sure which numbers are what is the outgoing paid by tenant and what outgoings come in your bucket. But for the purpose of calculation, when you're actually trying to buy a property, you need to make sure you remove all the outgoings from the calculation and make sure you're working only on net income number, right? So there is literally no outgoing as part of that number. And of course, land tax is also sometimes paid by the tenant. So the word I'm using sometimes is because, as I said, the lease can be bespoke. So every lease can be very different. So therefore, don't assume that all outgoings for that particular property that you're buying will always be 100% outgoings paid by the tenant unless it's written in the information memorandum. And you'll have to go through the due diligence period to make sure that that happens. So when you're signing the lease or when you're trying to buy a property, when you're signing a contract, just make sure in residential we have usually building and pest and finance as your clauses, which are the most common ones, plus maybe some other special conditions that you might be wanting to put in there. But in commercial, you can insert a due diligence clause to favor you. And that due diligence clause means that you've signed the contract probably based on the information memorandum, and you've just on face value of those numbers you are signing a contract with a purchase price value, but you really haven't done any due diligence. So you can sign the contract and the due diligence clause can actually allow you to complete your due diligence even after the contract is signed, and should the due diligence not stack up, you have the option to come out of it, which is why it takes longer to buy and sell, because sometimes even if the property is on the market for a while, but if there is a right buyer for it, and let's say I put a property on the market today, and let's say in a month's time I've got a buyer for it, and the buyer might sign the contract with due diligence clause, and they might have 30-day due diligence clause in there, which means by the time I would can be quite safe that my property is sold, this could be another 3 months with that particular buyer from the time I actually put that on the market. Now, if the due diligence doesn't stack for him, he could just walk away, or he or she could just walk away, which means I have to again put it back on the market. So that's why the buying and selling can be quite slow. So keep that in mind. Okay. The other important bit is the lease terms. So every in commercial you would generally have periods defined that how far will this lease continue. So the way it's written is 1 plus 2 plus 2. What that means is, one means it's the current period right now running. So you might say, okay, you have a tenant right now who signed a new lease until say June 2026. So that's your first year that's happening. And you might then see plus 2 years plus 2 years. What that means is they have an option to take up the next 2 years, and then after that they have another option to take another 2 years. So what that means is that by the time your first year finishes, before that actually finishes, a notice goes out to the tenant, and the tenant will be able to confirm whether they are going to take up the lease option or not. If they choose not to do it by a certain deadline, it is all within your right to actually kick the tenant out on the day the lease finishes on your current lease that's running, and you can get a new tenant there. So that date is, and time on the date is time sensitive. So it is, time is of essence. So it really matters. So if the notice goes out there in writing, they need to respond to that notice timely as well. So 5 plus 5 means 5 years plus another 5 years plus another 5 years. So you're committed to 5 years. You know your tenant has committed to the 5 years, and they are going to be there 5 years. But the next 10 years, that is just an option for them to go into it at that point in time. So that's what lease terms mean. And these are longer terms than residential. As I said, residential is 6 to 12 months usually. So you're probably recycling tenants if they're not staying. But in commercial, you could probably find that to happen a lot more longer. If it's a national tenant, let's say Nando's, for example, that's going to stay a lot more longer, of course, 5 plus 5 plus 5, because they won't really be there and run the business. McDonald's probably have a long leases as well. But if it's a small barber shop, for example, or you're in a regional area with a very small local tenant there, then the lease terms are not going to be likely 5 plus 5 plus 5. They're going to be shorter leases, which are probably going to be 1 or 2 years. And then you're sort of working with your business tenant to be able to work through and see how they can extend the leases. Right. Now, the most important one is the capitalization rate after the net income, right? This is where what we talk average. So when you are actually talking median in residential, we are talking about the average yield for a specific type of commercial property in that area. So let's say I'm trying to buy a retail property or a retail shop, and I look at a number. Okay, what's the rent on this? It's going to give me a net yield of 6%, 7%. Okay, that's the number. But when I actually look at per square meter rent for that particular property, and I compare that same retail shop with other retail shops in the area, I would get an average view of that and an average yield number. So that's called the capitalization rate. It is also determined by the risk actually of the property. It's a measure of the risk. And I'll explain that a little bit more through examples. But for now, just keep that in mind that cap rate is important, because you really want to know the average in the area, average yield of the area before you pick up or you buy the property, the one that you're interested in. So price is equal to net income divided by net yield. Just keep that in mind, right? You have to write this down somewhere, wherever you want it, you post it, you keep it with you. Every time you go to look at a commercial property online or you're going to buy something, just keep that formula in front of you. It is the simplest formula, but can actually be confusing at times. But it is really that formula that is deciding your value for the property. It comes down to that when you're buying a property or when you're actually assessing the value of the property. Of course, a lot more due diligence goes behind the scenes, but when you're putting a price to a property or a value to the property, it's just simply that particular formula. So price equal to net income divided by net yield, right? And value is equal to net income divided by cap rate. Okay. It's just that the price and cap rate are pretty much, or the value and price will all depend on how you see the denominator there. But that is a formula you want to keep in mind, and I will clarify this with examples shortly. So I don't want to stress too much over here. All right. So now what you're looking for is rent goes up, the value of the property goes up. Just keep that in mind. That's what that formula meant. Rent goes up, the value of the property goes up. Risk goes down, the value goes up. And that can happen overnight as well. As I said, it's not time dependent, right? But what you really need to do is, before you buy anything, do your detailed due diligence, potential to increase rent. So look at options where, if the lease is on month to month, how can I turn it into a long-term lease, right? the value goes up of the property immediately because you reduce the risk as a result, right? Look for options where I can add more tenants to the property. Like it could be a signage, it could be multi-tenancies. I can divide the space into two, three, four parts. As I said, warehouses, you can have multiple tenancies in one warehouse, right? You can put an ATM in front of a retail shop as well. So that is another tenant. So I'll show you an example of that and how the value changes, when you're adding tenancies. The strength of the tenant. So local tenant, a barber shop, an accountant versus a national tenant, can make a huge difference. A local accountant versus a national tenant type account, and an accountant can make a huge difference in your valuation as well because your risk reduces. And when risk reduces with national tenant, obviously the value goes up, right? So if you buy a property which is already a national tenant, expect to pay, a lot more money for that, which means your net yield is going to be very, very small. You'll probably not cross 2-3% net yields. But if you buy something which has got a local tenant in there and you're buying at a net yield of say 5%, 6%, and you change that tenant to a national tenant, you're bringing that yield down to 3%, which means the value is going up. And I'll explain that through examples. But you really have to keep this in mind that it matters who's the tenant and how can I change the tenant to really increase its value. The strength of the lease, so how long the leases will run for. The location, absolutely, this is critical. Commercial is all location, 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 right? To minimize your risk on vacancies, but at the same time, also when you're selling the property as well. Cap rates. So as I said, we'll talk about that in a second. And of course, you can renovate the property, you can subdivide, you can do other things. But these are the things you're looking for when you're actually, trying to lock on an asset to ensure that you've done your due diligence. So let's look at an example. Now, this is a property which is Westpac Bank is actually a tenant in the property. So it's a shop, a retail style type of a property that you can see over there. As I'm seeing the location, it is in one of the busiest areas over there. There's obviously other banks in the space as well. I can see IG, I can see BP over there, which is really good. So you've got lots of other national tenants around that property. Westpac itself is a national tenant as well. So it's really good that, I'm seeing something like this. And it's in a space lettable area, net lettable area is only 316 square meters. And it is expression of interest. So I have to decide the value on this property and put an offer on it based on the expression of interest, what I believe is the value of the property. It's leased to Westpac Bank. You have 3 years lease to 2026, which means we are in 2025. So one more year of lease, and then you've got options to 2032. Sorry, excuse me. Let me just get some water. Sorry. So you got 3 years lease to 2026, which means you're already 2 years into it. And there's one more year left of your current lease. And then there's options to 2032. So you've got another 6 years of lease after that, which is an option for them to choose. And you have a net income. Now it says the word net income, 47,380. So you've got all the other thing. You've got land size of 1442. There's an annual increase of 3%, which means the value will go up every 3% during the term of the lease. And then you've got 100% outgoings payable by the tenant. So all outgoings are paid by tenant. So therefore, the net number makes sense on the face value. So how will I calculate the value of this property? So we know that it is a going concern. There's already a tenant in the property, which is great. I've got options, I've got net income, I've got annual CPI, and now I have to calculate the value. So the value formula was net income divided by cap rate. Now, what I don't know out of this information is the cap rate, which is the average yield of a similar type of property in the area. So what I would do as part of my due diligence is talk to a few, shops around in that area, call a few agents, and actually try to get the number of what is the average yield that I come up with that type of property. So let's say that's 10%, right? It's average about 10% cap rate in that area. Then that would become my 10% number there. So I would use a net income divide by 10%. That becomes the value, and that will be my offer. So you can see there's no emotion. It's all numbers driven, and that's what my offer would go out there. So let's work this out. So let's say if it is a 10% cap rate, the value that I will be putting on this property or the actual purchase price for me will be anything up to 473,800. If I'm not emotional about it, I might put 450 and see what happens. That's up to me. I can put 500K, but I'll be actually overpaying that. So if I want to buy under value, I'll probably put 450 if there are not many offers over there. So hopefully they will buy that, which means I'm doing better than the market. But at the market value at that point in time, it means 473,800 is the maximum price I should pay for it, right? If the cap rate is 9% in the area, then I would divide 47,380, which is a net rent or net income, and divide by 9%, which gives me a purchase price of 526,444. That's the maximum that I would offer. If it's 8%, it's 592,250. So as you can see, it's simply the calculation value is equal to net income divided by cap rate, right? And that's what I would define how I would buy this property. So that's how you determine the value, right? What should I be offering? Now, let's say we have offered the value, and after 12 months, we also have an annual CPI. We bought the property, let's say at 10%, right? Cap rate back then, which means I paid the value of, I bought the property at 473,800 at 10% cap rate. Now, after 12 months, what will happen is the rent will go up by 3%. So which means that the new rent is going to be 48,801 in this case, because the rent went up 3% automatically as it's written in the lease. So which means that because the rent went up, and remember when rent goes up, value goes up. So immediately the value as of that date is 488,010 because rent went up by 3%, right? And therefore the change of value of my property is 14,210. A lot of people think that there is no growth in commercial. That is not right. It is similar to saying that my apartments don't grow in value in residential, but that doesn't mean residential doesn't grow. You really need to buy the right property. You need to buy with the right potential in the property, and you need to see how the value can change over a period of time. So if we had bought that at 9%, which is at 526,000 maybe purchase price, at 3% rental increase, the new value would be 542, and so is at 8% would be 610. And you can see the change in my growth value of my property just by 3% increase in the rent. Let's say this one, the lease was going to over next year, right? So what will happen is in, let's say it is June 2026, it's going to finish, right? Now, 6 months before, we send a notice, and the Westpac confirms that fine, okay, I'm going to extend, I'm going to take my option, and I will extend this till 2032. Now, before the new lease is signed with that option, there is a market rent review. So it's not 3% increase anymore. That 3% was the very first 3 years. Now, because I'm going to go into the option, I am now at a market review, which means there will be a market checkpoint of what that market is currently sitting at the rent. And that can completely change the new value of your rent as well. So maybe next year, instead of just 3% increases, it might go up 10%. And that means you can imagine how much your value has gone up suddenly as well. It'll jump by 10% as well, whatever the value was in the previous year, right? So as rents go up, value goes up. Risk goes down, value goes up. That's simply that you have to remember. Okay. So this is CPI increase example. The next one is what happens when the cap rate reduces. So let's say interest rates are going down right now, as we know, for example, right? So when interest rates go down, the businesses have the ability to get more stronger on their leases, so they are happy to stay longer in that property because they can afford it. They can even pay more rent as well because now they have, obviously more surplus cash flow because interest rates have gone down. And usually the commercials become really, really super strong in that time, and the value really goes up in commercial when interest rate starts to come down. Just as my observation, may not happen for every property, but you really have to, understand what I'm trying to say. So let's just say interest rates have gone down now twice. Let's say I bought this property maybe in January or maybe last year in October, for example, right? And I bought it at 473,800. And I know my net income was 47,380 based on this listing. And I bought it at a cap rate of 10% at that point in time, which is 473,800. Now, let's say after 12 months, I also had a CPI increase, which is 3%. So, of course, my rent has gone up. And also, it could be that the rents of similar properties in that area have also risen up, and they have gone up as well in that area. So market rents have gone up, which means my cap rate is now 9%, right? And not 10% anymore. And as soon as cap rate goes down, remember cap rate is risk. As soon as risk goes down, the value goes up. So therefore, my new rent would be 48,801, which is a 3% adjusted CPI, divided by 9%. And now my new value is 542,233 because my risk went down at the same time my rent went up as well. So I got double benefit now in the same 12 months, because cap rates went down and rents went up. That's how it is. That's why that formula is very important to remember that, right? So where I bought the property for 473,800, the uplift is $68,000 in 12 months. That's 14% increase, right? Just by cap rate going down and rent going up by 3%. So that's how the examples are calculated. Okay. So keep that in mind. Now I want to show you multi-tenancy and how value changes just like that. It's got nothing to do with the time. It's all got to do with the lease, rent, and the risk. So here we go. Let's say you have a tenant, right? And let's say that tenant is Vinny's. Now that's occupying 100 square meter space. And the cap rate is 10% again. And I'm taking using word 10%. It's easy to calculate, so it's easy to understand. Let's say the net rent coming from this particular property a year is $100,000, right? So what's the value? The value is simple: $100,000 divided by 10%, which is $1 million. So I will be buying this property at $1 million if I'm buying at a cap rate of 10%. Now let's say I buy this property at that $1 million by at 10% cap rate, and that's 100K, right? Now what I do, I actually want to, I see an opportunity where I can increase the value of the property. So what I do is, Vinny's has come to the point where, they want to maybe renegotiate the lease because they're at the end of their very first term, and they want to make sure that they want to get into the options, new options, but they don't want 100 square meters anymore. They only want 50 square meters. They only want half the size of their shop. So what I would do is I would split that shop into two parts. I would probably draw a wall, and I'd say, okay, well, let me give you 50 square meters of space, and I'm going to give other 50 square meters of space to another tenant. Let's say that's Tabcorp in this scenario, right? So as you can see, tenant A was paying 10%. When we bought it, it was 10%, 100K rent. So that's 1 million. Now I've got two tenants in the same spot, right? But two tenants, 50 square meters, 50 square meters. And now the cap rate has also gone down because why the cap rate has become better? Because I have reduced the risk. I've got now two tenants. So the cap rate has gone to 9%, and my rent has gone up to 140 because I can actually charge more per square meter because of a smaller space, right, to the tenant. So now instead of getting 100K rent, I'm also getting 140K rent in this example, which means my value is now 1.56 million. So I've made $560,000 just by splitting that space into two parts and giving one part to a national tenant, which is Tabcorp, and reducing my cap rate, but also increasing my rent, right? Let's say I get even more creative after this. I made half a million profit. Amazing, fantastic. But I've got more options here. I've got a place in Tabcorp in front there where I can put an ATM over there. And I've got this air lights over there where I can actually put for advertisement. I can now bring in tenant number C, which is the air rights to advertise. And that tenant is giving me $60,000 a year just to advertise there. And whereas I can add an ATM in the front of the shop there and get another $50,000 from there. So now what I've done is I've added from one tenants, I've added to four tenants now. I've reduced the cap rate to now 8%, and I've increased the rent to 250K now instead of 140, right? That changes the value to 3.1 million. Same calculation, right? Net rent divided by cap rate is my value. So new value is 3.1 million, which means I have an uplift of 2.51 million from a $1 million property. Now, this has got nothing to do with time. Let's say I was buying this property just when Vinny's was finishing their first lease or the first part of their lease, and they were in the time to whether they want to extend or not. And that's time I bought the property. Right at the same time, I could have negotiated with them and saying, okay, you only want half, we can do it. And right at the time of settlement, I could probably get this done, create this space, get all this done, and within less than 6 months from there, or maybe a year, I could change the value from 1 million to 3.1 million, and I could just take home $2 million, in equity straight up, or maybe even sell the property and cash in, right? That's the beauty of commercial. Numbers driven, no emotions, add value, reduce risk, increase rent, and I can enjoy the returns. Of course, This comes with a bit of a risk, but that's what it is. Here's an example of a current shop that we are trying to buy, 82 square meters net lettable area for, and they've said sale over 600K. So we've done some calculations on 610, and what we've come up with a net rent of 39,690, which is a net yield of 6.51% in a beautiful area near the beach. And this tenant has been in the property since 2019. So they're not going to leave. They don't want to leave. In fact, they're on month lease right now. What they want to do is the seller is selling the property. It's in a blue chip area. And there's, as in, it's a hot tourist spot area in Queensland. They want to sell the property and the tenant doesn't want to leave. And they have been there since 2019, which means they've seen the COVID, and even then the tenant doesn't want to leave. They're happy to now sign a new lease at a higher rent as well, and we are negotiating the lease terms right now with them. What you see on the right hand side are the expenses or what they are paying council. So right now all the outgoings are paid by actually the owner, because during COVID that's what the negotiation happened for to retain this particular tenant. The owner said, I will take all the outgoings. You don't have to pay the outgoings. You just stay in the property. And that's exactly what I meant by negotiating the right way to keep your tenant. So now that we are buying this property, we are now renegotiating with them and saying all outgoings are now tenants going to pay. They're going to also extend the lease and they're going to pay a higher rent to us as well. So the negotiations are happening at this stage. We are trying to negotiate to 3 plus 3 plus 3 years. We want tenants to pay all the outgoings. The net rent we want that to be 42,000 as opposed to 39,000. So that if the property management fees is also part of the outgoings, and then we can offer them a price of 600K, right? Because I think that's the price they want to buy it at, which means my net yield will be 7%. So that will be the cap rate. If the cap rate is 7%, I am buying it at 7% essentially. So my net cash flow from a 600K property is going to be 10,725, right? So that's how the deals are assessed. And then, of course, there's a lot of due diligence behind it. But at least from a numbers point of view, understand how we arrive to a number that we want to offer to the client. Sorry, to the vendor. Now, this is a property where we've got amazing property. We've got two commercial at the bottom. The whole building is owned, and you've got tenants on the top, and you've got one studio at the back as well. The asking price was 950. The purchase price was 900. The gross rent is 107,000. I would say gross. It means it includes all the outgoings as well. The net rent is 79,490 plus GST plus outgoings. So that's the difference between gross and net. And the net yield is 8.8%. That means, right? Because if you divide 79,490 by 900K, you get a net yield of 8.8%. So it's an amazing yield. Usually in the metro area, if you buy a warehouse, you don't get more than 3-4%. This is 8.8% because it's multi-tenancy. Risk is low. Amazing location. It is, as you can see from here, corner block. It doesn't matter what the land size is. It's on a small 300 square meter land, but land doesn't matter at all when it comes to value in commercial in this scenario. So the leases are already there. The tenants are going strong. So it's in a growth area. And obviously, just within 6 to 8 months, this property is close to valuing around 980 to 990 already, right? Just because rents have gone up, the area cap rates have gone far better. Area growth has happened as well. Residentials have gone off the roof. So a lot of dynamics have changed in this area. And as a result, the value of this property has also changed in a very short period of time. And that's what you want. So the net cash flow on a 900K property is 30,620. This is positively get, right? Buy two of these, you've got 60,000 coming in your cash flow. If you've paid these off, or these two properties, you are already sitting at 150K passive income, where we all started with a goal of 150K passive income just from two properties on 1.8 million. So if you've got 1.8 million sitting there, you want to buy a $2 million property, you could be getting this cash flow for yourself if you want to find a property like that. So this was what we bought for the client. This is another medical center. Purchase price 455, asking 470. Net rental is 40,838. Net yield is 8.9%. Net cash flow is 15,000. So again, this was amazing. Bought in South Australia. There is no stamp duty in South Australia for commercial properties, or majority of the commercial properties, and therefore, you save on stamp duty as well. That's just another property which has got a restaurant, and behind the restaurant there is actually a residential unit as well. So that's also multi-tenancy type, and there's a net cash flow of 16,000 only for $455,000. That's a dual occupancy. Actually, this is a story of a client who is bought three properties. They had other residential properties. They've sold off one. They're selling off another one. But they sold off one. They bought three properties. One in their super. Sorry, two in their super. One outside super. But all three properties are positively geared. Even the residential dual occupancy is positively geared because we bought that for 455. The gross rent is 670. So it's really good, and that's marginally positively geared. Then we've got this restaurant with a unit that's for 455K. The net rent is 40,000, and that's positively get by 16,000. And then we've got this tattoo parlor, which is in a business center. Now that can be changed into another tenancy, like a medical. There could be doctor in there down the line. There could be another consulting over there, but it's in a business center. So, and that has been running there since 2019 as well. Now that's for only for 315,000, and the positive gain on that is 5,500. So these are just three properties that we bought for this client within 12 to 14 months, and you can see the net rent is already $25,000 positively gained. So you've got positive income coming, with a $1.23 billion portfolio built so far, and there's more to go. So this is where it gets very exciting to work with commercial, and once you get used to commercial, in my experience, I've seen people don't have, go back to residential, but again, everyone has a risk appetite. But I hope you enjoyed the session tonight and you were able to come to understand the fundamentals of commercial and how commercial can change everything and how you can actually get to positively get properties. And that's really, we get super excited with something like that when it comes to the market and buy the right thing for our clients as well. Okay, so we are almost at the end of this. Any questions? Okay, nothing so far. Okay, maybe I explained that too well. That's amazing. All right, if you've got no more questions, thank you so much for coming tonight and listening to the basics. If you've got more questions that you want to ask us, feel free to reach out to us. We also run a Facebook group called I Love Property, and you can scan this code here and you can join the group. We share a lot of knowledge there. You can ask questions. There are lots of professionals in the group as well. If you want to have a personal one-to-one chat, please do so. Markets are absolutely screaming right now. We're across Australia where we are buying for our clients, both residential and commercial. If you think you really want to have a consultation and this is the right time for you to buy, we are also offering a discount at this stage before end of June, being the end of financial year. We've got 10 to 15% discount going on residential and commercial. So don't delay. Come and have a chat to us, book a session with me, and we can go through your scenario and tell you what might be the right thing for you. That's all. Thank you so much. This is Anubhav signing off from Find Me Real Estate, and I hope you enjoyed the session. Thank you very much. Yes, Sam, that's correct. This is very different to residential. Thank you so much for your comment. All right. Thank you, everyone. Have a good night. See you soon. Bye.